discuss, but one obvious thing is missing. And despite we're going to cover what Mark just mentioned in a little bit, Mark. I'm going to get to that in just a moment. Give me about 10 minutes, 15 minutes, Mark, and we'll get to yours. But Paul sent in an email today. And Paul said, recently I've been experimenting with short-term trades on SPY and some other underlying securities using long puts or strangles. Okay, kind of what Sam does as well, and kind of what I try to do also, but maybe just not as active as you guys are doing. Now today, you decided to use a Bear Put Debit spread. Bear Put Debit spread is a parity trade to a bear call credit spread using the same strikes and same expiration. Okay, so for those of you who don't know what a Bear Put Debit is, I'm going to enter a spread. Let's say my stock's trading here 50. I might sell an in-the-money 52 put, 52 strike put 1, 2, 3 weeks out in time, and buy, let's say, a 54. I'm going to keep a 2-point spread here, deeper in the money. So this might be $3, and this might be $4.60. Okay, so I've got a debit of $1.60. I'm selling this one, buying this one. I've got a debit of $1.60 on a 2-point spread, meaning I could, what happens? If the stock stays below 52, I'm forced to buy shares of stock at 52 essentially with my short put, but I have the right to sell them at 54, so I get $2 back, meaning I'm looking to make 40 cents on a 160 investment. Now I can close this at any time beforehand, but the maximum profit occurs when these two are adjusted intrinsic, or if I allow them to be exercised and assigned because the stock is below the 52 strike. That's a Bear Put Debit. Similar structure to a bear call, where I could sell the 52 and buy the 54, excuse me, and maybe here I got, where the put's $3 because $2 in the money, let's say I get 80 cents here, and this cost me 40 cents. So what do I have now? A 40-cent net credit, which I take in, but I have to put up the monetary requirement of $2 between 52 and 54, or $1.60 depending on your broker. Stock stays below 50, both calls expire worthless. I keep the net credit. Okay, so that's what we're talking about here, bird's eye view. We're going to look more in depth at it in a minute. I would like to know how you think about such trades. For example, I could have selected a bear call. How do you decide which one is best? Okay, it's a fair enough question. Secondly, your system, he means the PowerOptions portfolio tool, shows suggested adjustments to Bear Put Debit spreads depending on which way the underlying security goes. Paul's guess is that such adjustments are not relevant if I'm using options expiring 1 to 7 days. I agree. However, I'm still interested in knowing what you think of adjustments if I decide to open the positions lasting 1 to 3 months. Okay, it's a mouthful. We're going to cover 3 things. We're going to talk about the credit to debit parity view of bear spreads and maybe bull spreads as well. We're going to maybe just focus on bear spreads. Okay, how do I decide which one is best? There's a clear answer, but there's a caveat. I use the spread chain tool on PowerOptions to compare parity. We're going to take a look at that. Now, next, the adjustments if you open positions 1 to 3 months out. Well, it's similar to the management techniques I would use for a shorter term, 2-week out or 1-week out trade if my spread got in trouble. But we may be talking about different structures. There's something I will do with maybe a 1.5, 2-month, or 3-month debit spread that I would never do with a credit spread. Okay, so let's pause there. Let's navigate over to PowerOptions, and Mark, I'm going to keep your question right here in my pocket for a moment, and let's just take our standard example. All right, so I'm going to navigate over to the PowerOptions suite of tools. What we're looking at here is the trial account. If any of you have just started a trial, I encourage you to take advantage of the 4 steps listed there to get better acquainted with tools. Free start guide, flash tutorials, are wealth of knowledge in the webinar archives here as well. And of course, you can schedule a coaching session anytime. Now, let's just go to the custom spread tool. I'm interested in a good probability. I would use the search tools to find this, but let's say I'm interested in a good probability bearish spread on Amazon or Apple. Now, Sam made a comment a little while ago about he thinks we're going to go into a rally into 2019. Okay, the first couple weeks or so. Okay, nothing wrong with that. That's his thoughts on the idea there. Then that's perfectly fine. He could be very right. He says we're going in for a rally next year. Okay. So we might take a look at that. I mean, that might be something to consider. But for this example, we're going to discuss a bear call in AAPL. And we've got various weeklies. I don't want to go to the 4th at 7 days out. I'm going to use my standard 14 days out. I'm going to go to January 11th. Apple's at 156.23. I think the stock's going to maybe rally, but it's going to stay below 160. I want a good probability, though, but it has to match my requirements. I'm going to eyeball this. I would save time just doing the search in this case for what I look for in my positions. All right. Bear call credit spread. I think I see the one I want. Maybe not. No. Actually, that's not that bad if I get filled at midpoint, which is key. I think I'm going to go, this is not a trade recommendation or suggestion. This is just for example purposes only. I'm going to go 165, 167.5. I really think I should go 167.5, 170, which would give me about 20 cents. That's more realistic. Yeah, that's more realistic. Let me clear that out. So if I get midpoint prices here, I'm going to do 165, 170 bear call spread. Okay? Let me just submit that. Sorry, folks. There we go. There's my bear call spread. Return is too low for me, probably. It's 9%. That's pretty good. We'll just stay with it. I'd probably go in 11%. Anyway, minimum. Here we go with this one. Bear call credit spread. Okay, Billy, I'm just scrolling through. BillyBob, I got another question here as well. Okay, there we go. Bear call credit spread. I take a credit up front as long as the stock stays below 167.50. Both calls expire worthless. We keep the net credit 14 days out to January 11. It's a 2.5 point spread. So I'm taking in roughly 23 cents. Let me just do this. We're going to say 22 cents. I don't like it when it throws in that 50 cents. So there we go. We're taking in 22 cents on a 2.5 point spread. So my risk is $228. Again, if the stock stays below my strike of 167.5, both calls expire worthless. They're out of the money. I keep the net credit. Okay? So 9.6%. Return. 22 off 228. Not a bad trade. Sam does remind me, of course, because again, this is just for examples for the comparisons. It's not really saying this is a good idea. He says Apple earnings are coming in January as well on around 31st. Right. So I would never do a bear call, bull put, or bear put debit of this fashion going into earnings. It's not worth the 10-to-1 risk-reward ratio for an unexpected move. Here's a spread. 2 weeks out. Let's just look at the numbers. That's a bear call. Now we're going to look at the same chart, but with a different trade. Bear put debit be the same thing, but I'm going to sell the in the money lower strike 167.5 put and buy the 170. Okay. Let's do that. I've got a debit of 217.50 at midpoint. What does that mean? I've got to pay $14.20 for the 170 put. I'm going to get $12.03 midpoint roughly for the 167.5. All right, so it's about 217. Rounding. I apologize, rounding. There we go, 217. So now, what's my maximum loss? 217, the debit I pay. What's my return? If the stock stays below 167.5, I do nothing. I'm going to be forced to buy shares of stock at 167.50, but I have the right to sell them at 170. I get 2.5 points back, so I make $33 or 15.2%, a 50% higher gain than the bear call credit spread. Right now, Paul, I would say that this is the better trade. It's a higher return. It's more bang for my buck in the exact same structure. It has the exact same probability. Both the probability below the short put at 167.50 and the probability below the short call at 167.50 are the same. So I have the same probability, similar risk reward, but a slightly lower risk and a slightly higher return here. Just looking at that, Bear Put Debit, BPD, 15.2% return, $33 max profit, 217 risk, which is the debit you pay in. Now, as opposed to the BCC, the Bear Call Credit was $22 of a risk of 228 or 9.6%. We know they both have the same percent probability, same theoretical probability. Apple would be below 167.5 in the next 14 days. So this seems like the obvious choice. Now, oh, sorry folks. Another issue here, and it's not related to you, Paul, I know. We've talked about sort of your account size and everything. It's not an issue there. But if you're just starting out and you're telling me you're trading 1 or 2 contracts of these positions, I have to remind you of something. And what I have to remind you of here is that this profit on this debit is only realized, the max profit's only realized at expiration. When all time value is gone, when you're forced to buy shares of stock at 167.50 and you sell them at 170 to get the full 250 back. If you do that, if your broker does that, they may charge you as much as 2 commissions. They may actually charge you a commission for buying stock and then selling stock. Okay? If you close the spread before earnings because you've reached near your maximum profit, right? You're getting $31 instead of $33, still better than the 22 cents over here, but you have to actively buy to close the short and sell to close the long. Your broker might charge you 1.5 commissions for closing the spread, or they might just charge you 2 commissions for closing each leg, right? So this does require 2 extra commissions. So if you're doing just 2 or 3 contracts in a smaller account of this position, you have to factor in the extra commissions. And does that still give you more of a profit? Third thing that's complicated when comparing the parities. We looked at the Bear Call. Now we're looking at the Bear Put Debit. I'm showing you the comparison at midpoint. Okay? That's important to note because when I go back here to January 11th, my 167 call has a bid of 75 and an ask of 94. It's about a 20-point spread, 19-point spread. So I could assume that getting 8 cents more, 83 cents or 84 cents here is not out of bounds. It's not too wild of a midpoint fill. The 170 is 50 to 74. It's 20 points. So yeah, I pay 62 for it. Not too bad. 84 to 62. It's not too wide of a bid-ask spread because they're out of the money. They have a smaller range. You go in the money. Now you're looking at $1 bid-ask spread, 90 cents. Are you going to get filled at midpoint? Likely with a stock that's this active and only 2 weeks out in time. But the deeper you go in the money when you're looking at a debit spread, the wider the bid-ask spread is going to be and the less likely you might get filled at midpoint. Okay, midpoint is a fair comparison. It's a fair comparison to use because you want the best bang for your buck too, but you may not be as likely to get filled at the midpoints on an in-the-money debit spread as you would with an out-of-the-money credit spread. I'm not saying there's a guarantee you're going to get filled out of the money as well, but that's a range. We're talking about being a little bit more lenient with only a 20-cent bid-ask spread as opposed to a 90-cent to $1 and assuming we can get midpoint as well. Now, I mentioned that I wanted something specific. I wanted a spread on Apple, bearish, 2 weeks out, 2 strikes apart, and I want to see is it better for the credit or the debit. It still has to match a return I want of at least 8% for those 2 weeks. Here's what I'm going to do. I'm going to go into one of the spreads, Bear Call Credit, Bear Put Debit. I can even go to Bull Put Credit. And I'm going to go into the spread chain. I can also take a look at it up here. If I just put in AAPL and click on Spread Chain. In the Spread Chain, we show you a matrix of possible spreads on a stock. I can look at bear call and bull put together. Why would I do that? It's a good view to sort of build an iron condor on the fly using midpoint prices. Debit spreads, put credit and call debit parity, or call credit and put debit parity. Okay, so this is my bearish one. Bear call credit, bear put debit. 2 strikes apart, minimum 15-cent credit good. A probability, I'm going to say 75 to 90. Minimum return, 9%. And I want January 11th. Oh, it's got to be 250 spread. My apologies. We just saw that. Okay. There we go. Okay, sorry. So what am I looking at here, Paul? This tool is showing me the parity of the two. On my right is the bear put debit. The put spread here, this is showing me the debit on a 250 spread and the return. Okay, probability is the same. Over here is my bear call credit. And you can see right away what I'm going for here. The 165, 167.5 I said I wanted to do does give me a 26% return with the bear call credit and a 28.2% return on the debit. I'm going to be leaning this way. Probabilities are the same, but then I'd want to look at the bid-ask spread. Okay, so I'm going to open up that plus sign there, similar to what we had. Oh, I'm sorry, this is selling the 165, buying the 170. I said that wrong first. I apologize. So 985 to 1030. That's not too bad. 45 cents. I'm sorry, 55 cents. No, 55 cents. Okay. And then this one here is the one we saw that's near $1. So if you feel confident you could get midpoint, I'm going with this one to get more bang for the buck. If that extra 2% potential gain from 26.3 to 28.2 is not negated by factoring in the extra commissions to close the debit spread. That's a choice you have to make. Can't make that for you. Okay, but when they're this close, I'm probably going to stay with the credit spread. For some reason, the midpoints on the next strike are skewed. The one we were looking at, 9.6, we saw the 22-cent net credit versus 14.7 here. I'd look at the midpoints again by clicking that plus sign. Do I feel confident I'm going to get the midpoint? I'll go with the debit. The other one here, 13.6 versus 4.2. Something's wrong with these midpoint prices. One of them is too wide, likely the buy one, so it has an increased value, so it has such a low return. So rather than even mess with that, I'm going to try to get midpoint here, unless the midpoint on the credit spread looks too obscure. On a side note, I don't necessarily advertise one broker over the other. I don't push one broker over the other. But Sam says that you could, of course, always look to use something such as Robinhood, the free commission broker, of course, if you wanted to eliminate commissions because you're using smaller size contracts of credit spreads or debit spreads, or just to help long term, as they have been enhancing their options tools, I guess, their options formats and entry, Sam, I guess is the term I'm looking for, over the past several months, and have had them open for a few months now. I think it was September, if I'm correct, when they started releasing that. Okay, so that's what I use to compare the two. With those thoughts in mind, of even though this shows me a higher return, do commissions come into play that would negate the benefit of that return, and how comfortable am I that I could get midpoint on the in-the-money puts or the in-the-money calls with the bull call debit versus the midpoint on the out-of-the-money calls, out-of-the-money puts in the credit spread aspect. That's my answer. I'd use the spread chain tool to do it, to compare the two for parity, see which one is better. Management. Okay, management now. Let's go back. I don't like to use the back button too much, but I'm going to go back. There we go. Let's go back to the debit spread here. And I'm going to do this two ways, okay? Let's say that instead of this spread that we just saw, that coming up for next week, January 4th, I had sold the 155 and bought the 157 Bear Put Debit spread on Apple when the stock was trading at let's say it was trading at 146. I forget if it was down. Let's say it was trading at 146. I did the 155, 157.50. Again, looking at that sort of 30 cents or so, 30 cent max profit off of a 220 debit. Okay, so let's say sold this for 1, sold this for 320. Okay, so me a 220 debit on a 250 spread, very simple, 13.6% return, but the stock has moved up against the strike prices. Now, in this particular spread that I'm showing here, yeah, Sam, I'm not using this as an example of do. Sam says, I think do a bull put in Apple because before earnings, Apple will rally. Trader will buy Apple, hoping for positive results in the market. Well, yeah, this is just looking at what we were talking about for the management for Paul's discussion. I'm just looking for a bear put that's going against us. Doesn't matter what stock or what strike. I just want to look at an example. Now, Paul, as you know from our previous discussions, what I'd normally do, Apple's only offering 250 strikes for this expiration. It's not offering $2 strikes or $1 strikes as well. What I typically like to do is always leave one strike in between. So in this case, what I might have done is sold the 155 and bought the 160 if it matched my other criteria. Why? So just like with a bear call credit, if the stock starts to move up, I'll apply potentially the same sort of 8 management techniques, but I do lose one. There's 7. What's the first one? Close the position, take the loss. No one wants to do that, but it's an option to avoid further losses. Number 2, buy to close the short, move it up 1 strike. Graph it to make sure that it works. You'll get a lower credit. I might only get a 7 or 6% profit here, but what I'm doing is moving the 155 to the 157.5 if I had the 160 open. So I still keep a debit spread. I give myself a little bit more cushion to the upside. I'm still making some profit, but I'm just going to roll, in this case, roll the short only, 1 strike. Leave the long alone. That's why I always leave 2 strikes between in my credit spreads, to have the option to do that. 3, naturally, liquidate the whole spread. Move it to January 21st, January 28th, another 2 weeks out in time at a 160, 162.5, 162.5, 165. If you think the stock might recover a little bit and then move back down, right? That's still dependent on moving back down. Number 4, liquidate. So 3 is liquidate and move up. I usually don't like to do that one. I list it because it's popular, but it's not one I usually ever use. I usually try to convert it to the different direction, which would be number 4, liquidate your spread, your bear put debit, take the loss, and look for, now that the stock's going in the opposite direction, a bull call debit or a bull put credit. Change the direction. So you liquidate and then open opposite. Okay? Now, number 5, you could still do it as we do in the credit spread. You've got a bear put debit that's starting to move against you. It's near your trigger point. You want to give yourself a little bit more cushion. You could open a bull call debit to create a debit condor. If I had a credit spread open, this would be just create an iron condor by doing the opposite. Here you're just creating a condor, doing that one, okay? I'm sorry, condor. There we go. All right, so we could create a condor. So we've got close, roll the short 1 leg only, liquidate and roll further out in time, liquidate and do the opposite, create a condor or a butterfly. Not a fan of butterflies. You guys know that. We've talked about it before. Number 6, of course, would be in this case the pendulum adjustment, in which case I would sell to close the 157.5 and buy, I'm sorry, the 152.5. Yeah, I was right. Buy the 152.5 to turn my debit into a bull put credit with the stock going the opposite direction. So close the spread, roll the short, liquidate and roll. Close and do the opposite. Create the opposite. Oh, well, we haven't talked about the The pendulum there, yeah, that would be the pendulum is number 6. Sorry, I can't think of the 7th one off the top of my head, but the one that's missing, the one I can't do right now, the management technique we can't do in a debit spread, now that it's between us, I can't buy to close the short and leave the long open. See, if this was a bear call credit, and as Sam's projecting, Apple starts to continue to move up, it's going to cost me a lot to buy to close that short call. But if I just leave this alone, I'm now in just a long call position that will continue to gain as it continues to move up. And as long as the gain is more than the cost to buy back that option minus the net credit, I'll be at a profit. I can't do this in a debit spread. I can't do this in a bear put debit because if the stock continues to go up, this put's just going to continue to lose. And if it's above both strike prices, what happens? Both puts expire worthless. I lose my 220 net debit. Okay. So I don't know why I'm missing another one there, but it's there. One of the obvious ones, it's there that I would use. I can think of it. So I would just close the whole thing. I can't close the short and leave the long open. That's the one that's missing from this. Now, I want to convert this to something else. Okay, for Mark. Oh, no, wait. Mark, one more second. I had mentioned that if you want to go 3 months out in time, that's the management techniques I would approach in anything. Let's take Apple right now. On Apple, I already showed that if I'm doing a 2-week out or 3-week out spread, I'm looking for something with that 70, 75, or 80% probability. If I'm bullish, as Sam mentioned, he's bullish. I'm not. I'm not going to say, I'm not going to put myself there one way or the other and have someone call me up from the SEC and say something, hey, you're giving trading advice. I'm not going to say that, meaning I'm giving directional trading advice. In any case, let's go 75 days out in time. And normally if I was opening a bull put spread 3 months out, I'd still want to be out of the money because I don't want to get assigned early, right? I might want to sell a 150 and buy a 145. Sell a 145, buy a 135, something like that. I want to be out of the money because I want the higher probability. In comparison, you say, well, in a bull call debit, wouldn't you do the same? You'd go in the money. Well, if I'm projecting a movement and I'm going 3 months out in time, I can do an out of the money or straddling, it's not a straddle, but fencing around the current stock price, sort of what we call an out of the money debit spread to get closer to just a 1-to-1 risk reward ratio. I might sell the 160 call, buy the 155. Assuming midpoint, what does that give me? Well, that gives me a 1-to-1 risk reward ratio. My debit is 250. I can get 5 points back. It's a 1-to-1 risk reward ratio. And if the stock continues up and is above 160 at March expiration, I'll get that full profit. It's above 160 between now and March expiration. I can close for maybe 230, 220, 225. I don't know. It won't be the full profit, but it might get close, especially if it moves up. So this is a low, on its own, this is a low probability bull call debit spread, straddling the strike prices. So this is where I was talking about, Paul, when you said, what adjustments would I use for open positions 1 to 3 months out in time? I said similar to what I would do with shorter term, but you might do a different structure. I would do this as a bull call debit, 3 months, 2 months, 2.5 months out in time, okay? Where it's a 1-to-1 risk reward ratio, if in fact that is the direction I think the stock's going to go. A bear put debit would be similar, except for I'd be selling the 155 and buying the 160. Now, let me clear that out. If I would do this with a bull call debit spread, why would I not do this with a bull put credit spread at the same strikes? Because if this was a put, I'd be selling a 160 put that's in the money. I can be assigned at any time. And I'm not going to exercise the long put because the market's different. Do I have the capital to buy the shares of stock here, 10 contracts or 15 contracts? Do I want to hold an in-the-money short put going through earnings? Probably not. Okay. Advantage with this case, though, is that I couldn't end up being short stock to pay the ex-dividend if I cross it, which could happen with the bear call setup straddling the price. only do this with a debit spread. And in this case, of course, if stock does different things, what are your management techniques? Well, if the stock falls, number one, you've got time on your side, so that opens up some other ideas. Okay, I could roll the whole spread in to different strikes for potentially a lower profit but a higher probability. Usually I can't roll the spread in when I'm doing a 1 week out or 2 week out or 3 week out position. It's not logical to do that. But if I'm 3 months out, I might be able to roll this in at different strikes, still have a positive return with a better probability and not much risk. That's something that's different. Okay. You could do shorter, I'm sorry, you could do the opposite. So opposite structure. So here's my bull call debit. I could do high probability bear put debit spreads to create a credit condor short term to continue to lower this amount of risk if these are profiting. Almost treating it like a calendar condor. It's very strange. I've seen it done. Haven't done it myself. But it's an interesting thought, because this is your long-term plan, but shorter term you can play inside of this to try to make profit to lower this risk and increase this end game as well. It's kind of interesting. But I would only do this fenced structure, straddling the stock price again in a vertical spread. I don't like to throw a straddle term out there because it implies something else. But here, surrounding the stock price, I'd only do this with a debit. Never do it with a credit because of the risk of early assignment, especially 2 to 3 months out where you're going to cross ex-dividend date, earnings, and plus we're probably going to be in a volatile market. As Sam's saying, we think we need 85 to 0% probability with the volatility that we're in. Okay, 85 to 90% he's saying. Okay, so this gives us other ideas to manage based on the structure you use. But as far as just a shorter term debit spread, you had already mentioned, Paul, that if you're just doing 7 days out, you're planning on getting the max profit, so you're not going to roll in between. I get that. I understand it. I agree with you. But if you do the farther out debit spreads that are out of the money to try to get that 1-to-1 risk-reward ratio there, you're probably going to be managing it anyway as the stock fluctuates up and down in the near term. But there are some other interesting things we can do in calendar concepts, doing other things shorter term inside this larger trade to help us and to manage it as well. Now it becomes something that's sort of a whole trading plan that might get a little complicated as well. But if it starts to move against you and move down, you've got time on your side and you've got the ability to make adjustments on that also. Okay, so that's the discussion on the debit spreads versus credit spreads, using the spread chain tool to compare the parity of the two, see which one gives you the best bang for the buck, factor in what you know your contract size is going to be and what your commissions are, realizing the debits take an extra 2 contracts or 2 commissions, I'm sorry, and how does that affect your game plan? Is the increased return that you might see on a debit versus credit with the same strikes and same expiration worth it when you factor in the extra commissions as well? Okay. Oh, and by the way, I would never do this short term. I think I said that, but just to reiterate, I would never do this 2 weeks out, 3 weeks out in time. I would only do this structure where the short option is out of the money in a debit spread and the bought option is at or slightly in the money. 1 month, really, no, I'd say 2 months, 2.5 months, 3 months out in time. If I'm doing a spread that far out, I do it this way. On paper, it does look great because I have a 1-to-1 risk-reward ratio, but I still need to make sure I'm making the maximum profit more often than I'm losing the maximum loss if I end up holding it all the way to expiration and do no adjustments. Okay, all right. Sam just adds that he bought calls and puts for February. The calls and puts he bought this week for February and just had a spread go to 0 on Apple with the 165, 162.5 strikes. All right. And your contra ETF portfolio is 30% gain. You're just throwing that in there. Okay. All right. Mark, real quick, and then BillyBob. All right. So might not be the same structure. So let's cheat. Mark, let's get a good gauge. I know I'm at 156.25 right now, right? 156.25 on Apple. I want to go back a few days. So let's just go to the chain for Apple. And let me just go back. On your trial, you have the ability to go back 3 months worth of history. 13th? Sound good? Too much. Too much, but no, we'll use it. Okay, so for next week, on December 13th, when Apple was at 170.95, I may have seen a plausible trade 22 days out for entering a 157.5. I got to open it up to medium. 150. I want a 157.5, 152.5 bull put credit spread. Okay, I'm sorry. 157.5 put is, we're going to call it $1. We're going to be nice to ourselves. And we're going to call the 152.5, 55 cents. Sound good? Little cheat, but skewing it in my favor, but that's okay. All right. So what am I saying here? I'm saying on December 13th, when Apple was at 170.95, I'd have opened a bull put credit spread selling the 157.50, which had a probability above of, probability above of 86.4%. That's probably right in my criteria wheelhouse. Very good. All right. Now, let's go to the custom spread tool. This is for Mark in question about the pendulum adjustment. Wouldn't it cost too much to do it? Sometimes it works, sometimes it doesn't. Really works best when you're between the strike prices. So I'm going to sell my 157.5, 152.5. Buy. Bull put credit spread done on December 13th. We sold this at $1 even. Bought this at 55 cents. Is that right? Yeah, 55 cents. Net credit of 45 cents for a 250 spread. 9.9% return with an 86% probability at the time I entered the trade. Okay. All right. So here it is between the strikes. I think Apple's going to continue down. Opposite of Sam's thoughts, this bull put spread is losing, but I think the stock is going to continue down. This is going to be expensive to buy back. This one here is also gaining in value as the stock is falling. I want to sell to close the 152.5. I'm going to try to keep the same strike difference, 5 points, Mark. And I'm going to roll to the 162.5. So I'm going to sell to close this, buy to open this, BTO. So what I'm essentially doing, I'm swinging this here. That's why I call it the pendulum adjustment. I'm going to create a bear put debit spread for January 4th by rolling one option of my existing bull put credit spread. Sorry, folks. Hopefully to save a little commission as well. In order for this to work, the new difference in strike prices here, that stays the same, I'm sorry. The new difference in strike prices here, 5 points, has to be greater than the debit I'm paying minus the initial net credit of 45 cents I took in. Okay, let's take a look. What do I need to do? I need my long. I'm not moving the short, I'm moving the long. I'm going to sell to close the 152.50 for about 180. No, 177-ish. Buy the 162.50 for 710. This isn't going to work, I don't think. All right, so we sell and buy one. I'm just going to let it grab midpoint. 178 to 710. Okay. Does keep me at a profit. This is the new position. I took in 45 cents. And I'm paying a debit. Let's get rid of that 50 cents here. So 177. I got to put 178 in there. It's rounding to midpoint. Let me get the true one in there. There we go. So 1.3%, $13. So we're going to pay a debit of $5.40, $5.32. That's perfect. That's it. That's the math right there. I'm sorry. That's it. Okay. So here's what we're doing, Mark. We rolled this. This roll is a debit of $5.32. Don't worry about it moving 10 points, okay? It's just 532, 178 minus 710, or 710 minus 178, however you want to look at that. So it's 532. I took in 45 cents initially from the net credit of the initial bull put spread, and my new strike difference I get back, if I'm right, is 5. So we're taking in 545 to pay out 532. The difference is 13 cents, or a 1.3% return. Am I saying this is the best repair in this situation when I was originally in that bull put credit spread where the stock is now between both strike prices? No, because I don't know what's going to happen next. What I'm saying is that this is a repair where the stock has moved against me and it looks like it might continue down. I move one option so that in the next 10 or 11 days, I'm in a position that can still profit even though the stock's going the opposite direction from my original thought. Even if it stays exactly where it is and doesn't move, I make 1.3% rather than liquidating now and taking close to 40 or 50% loss of the maximum loss I thought I had. Risk, if it reverses, I'm risking 487. Okay, or no, I'm sorry, 987 because it's a 10-point spread. I apologize, 987. Almost missed that. So I'm not saying this is the best repair, but I'm saying this is how the pendulum works. That although the debit, the cost to convert that bull put credit to the bear put debit in this case was expensive. It cost me $5.32 to do it, but I already took in 45. So that difference there, if that's less than my new difference in strike prices, I've converted from a bull to a bear on a stock that's moving down to still keep a profit on the position. Well, Sam, yeah, you can see exactly what that is. Sam does add, just reiterates what I was just commenting on, that this converts it, but it does increase the risk that there's a rally. I do this in the situation where the stock suddenly has gone against me and for whatever, could be bad news or anything, and now it's between the strikes and I think it's going to continue down. I'll convert with one movement. It's not a great return, but it saves me from a 40% loss or worse. Okay. No, okay, this is one thing. I'm not going to spend too much time on this, Sam, because this is completely covered in the 8 ways to manage a bull put spread. Sam says, why not just open an iron condor? I don't like doing that. Not at this point. Okay, let me go back. Oh, sorry. Let me go back. If I open an iron condor now, Sam says, how about opening an iron condor, sell the calls? If I open a bear call at this point, this is going to move this up, yes, and it will lower the break even. But if the stock continues down in the direction against the bull put I was already in, I was wrong. I was wrong on the direction of the stock. It's moving against me. I need to take care of this. I need to change the bull put, not leave it in place and add another spread on top of it. Okay? If I just add another spread on top of it, I'm still in a trade. The stock's moving against me. And selling the call lowers the break even. You're absolutely right. It gives me a bump to the maximum profit if it recovers. Each repair comes with its separate sentiment. Okay? Each one has its own setup. If I think it's going to continue down, Sam, you're right. I'm going to buy to close the short put, leave the long open. I'm going to do the pendulum adjustment. If I think it's going to recover, I'm going to do nothing. Might sell an iron condor. Absolutely. Do the bear call, create an iron condor. Or lower the strikes to give me a little cushion if I think it's going to stagnate or move down. Each time I consider an adjustment for a vertical spread, I have to ask myself, what are my next expectations going forward? Okay. Mark adds, so summary, the total cost of the pendulum, the debit, needs to be less than the created spread. Yes, the cost of the debit minus the credit, and that's what you mean by total cost. I understand that. So the cost of the debit to roll minus net credit needs to be less than the new difference in strike prices of the debit spread. That's right. Okay? All right. Okay, so Yeah, that's the only reason why I don't like that, Sam. I don't like just adding an iron condor in this situation. If it's falling close and I think it's going to recover, I'll do that. But once it's between the strikes and it's still moving down where I need it to move back up, what's hurting me is this here. That short put is what's hurting me. I need to do something with that or leave it in place and use that as a pivot to create a bearish spread if I think the stock's continuing down. All right. I need to move on now to BillyBob. New approach here. Okay, oh, sorry, Billy, I had to read the whole thing first so I was clear on it. BillyBob says, I'm tired of getting slammed in several different types of spreads over the year. Okay, you said you love the idea of bulletproof positions that we've been teaching for the radioactive trading techniques and more. Okay, what percent of my future trades can I actually get bulletproof or close to it? Depends on the year, okay? On average, rough average, no, this year, about 30, I think 35% of it, it was 3 or 4 out of 9 trades. I can't remember. So it was about 33% of my trades that I was in this year were bulletproof, okay, with a lot of volatility. Let me get to SPY. Let me just go to the quotes page for you, BillyBob. I just use this as a broad market indicator. Every stock's different. But again, of the 9 trades I've traded this year, 3 of them were bulletproof at one point or another. No, 4 of them. 4 of the 9 were bulletproof at one point or another. One of them I took out of bulletproof status for higher profits. Strange situation. I made an adjustment to take advantage of further upside profit, which took me out of bulletproof status, but it was bulletproof. So 4 out of the 9, almost 50%. I believe in 2017, that was about 50%. But again, you take a look at the different market. Right, here's 2018. Here was 2017. Half to slight, I think, yeah, more than half, but 6 out of 10. It was really about 6 out of 11 trades. 6 out of 11 radioactive trades in 2017 were bulletproof at one point prior to expiration. By prior, I mean at least 2 to 3 months before expirations. And when I have no risk, I'm allowed to do spread trades inside of that structure. Okay, inside of the married put structure, do spread trades without any risk because I've already covered it. Okay, on average earning, I would say 30 to 35%, about 33%, a third of your positions. That's usually our track record over the 10 years I've been doing it, and Ernie's been doing it as well, will become bulletproof. Okay, in that situation. So that's something to consider there to answer your question. Now, you say something that I'm a little bit concerned about as far as the phrasing goes, BillyBob, and I don't know if you meant it this way or if something else. Now, when I talk about a spread trade with no risk, I talk about doing a preferred spread trade, one of the 12 different income methods in the blueprint, okay, where I start off with that protected structure, and I can do certain spreads in this that don't require any margin inside of the bigger nested trade. They don't require any capital to put in to take on the extra risk of the spread. For example, I think I have do I have my new Starbucks position? Did I actually roll that with everyone here? So there's the SRG position. Well, let's just use SH right now. That's up and it's a low risk position. What do I mean by that? Well, let me take SH real quick. And SH is an inverse, but let's just ignore that for the moment. Let's just look at the actual graphs. Okay, let's ignore what SH is. Let's ignore what the market's doing. Sorry, let's just look at the spread. So SH is currently at 31.64. A standard bear call spread. I might sell the 32 at the money and buy the 34. 2-point spread. Going to get about a 20-cent net credit. Oh, I'm sorry, 45-cent net credit. Well, it's a 29% return, but I have to put up the margin, the 2 points between, to trade it. And if it was a bull put, of course, you have a different view. What's wrong? If SH moves up, I start to lose on the position. Now, I take that into a context of a low-risk married put position. This was JD's, I believe. And I do that same spread, 32.34, because I'm already in the stock and in the put position. I don't have to put up the margin. It takes off of my risk. I get a little bump here, sure, I get a little heartbeat bump, but it still is infinite upside if the stock continues to move up. Okay, so it's a bear call spread where I don't have any risk on the position. Am I showing the right screen? No, I am not. I apologize. There we go. Yeah, the screen. Sorry, guys. The screen wasn't gone. It was this here. So let me go back to this. There we go. Okay. All right. There we go. So here's the bear call. 45 cents on a $2 risk or 155 true requirement. Same spread done in the context of owning the stock and having a put. I don't have any extra risk. In fact, I cancel all of the risk on the position and enter a bulletproof trade to the downside, and I have infinite profit to the upside. Okay? Now that's what we're talking about with the riskless, sort of a riskless spread trade. Okay? And again, I already answered BillyBob that our expectation is a third of our positions will be bulletproof, but if 2019 is more of a gradual lower left to upper right, as we saw in 2017, I'd expect that to get up to half, okay? All right. And yeah, so that's the situation there as well. Okay, so that's what we're looking at as far as the spread trade goes, the riskless spread trade. Yes, there is an obligation here, but done properly, you still have profit in any direction and you're still bulletproof in this direction. You won't be bulletproof the first time you do a spread trade, of course, depending on the movement of the stock. It'll take time to lower some of the risk, maybe 2 or 3 adjustments, not using weeklies. too little premium there in the bear call spread on the weeklies to get you to bulletproof status from a starting point of low risk. Okay. All right, so I mentioned that because is it possible to make more bulletproof if I'm willing to take smaller rewards? Would love to set a bunch of bulletproof trades and then just go to my island in the abacus. Yeah, there's a way to do it. There's not a way to do it. It's not exactly the best way, but it depends on what you consider your goals. I forget the numbers. I'm going to have to fake them, but I'm going to show you something that I kind of didn't. I had to talk to a customer about today. He's happy with the position. I don't remember the specifics. What I'm going to say is I think he got into Kirkland at about $23. And he was holding a April? No, it was a July. July 25 put that he had paid $4.50 for. Okay? Or something along those lines. Let me see if this works out right. Too high. Maybe $3.75. Perfect. Okay, so something like this. Well, as you can see, the stock is above his his put strike price, right? Got in at 23, at the 25 put, stock's now at 25.25. When he emailed me, it was actually higher, it's about 26. One of the methods we teach in the blueprint, my favorite one to reduce risk when the situation's right, even though it adds to a debit, but it reduces the risk the most, is income method number 4. The put that he paid for isn't at 0. Yeah, it lost some money as the stock moved up, but it still has value. And as the stock's moving up, the higher strike put has lost value as well. So we can take advantage of that by rolling the put up in price. Now this bulletproofed the position. Rolling to the 30 bulletproofed the position, but only to 0.3%. What he actually did is he rolled up to the July 35, wider spread. When he had his numbers had him at I think 6.4% bulletproof status, if I remember correctly. This is when the stock was at 26. It was a little bit higher. So he had about a 6.4%. Maybe I'm confusing trades here. I'm confusing trades. That was another customer I was talking with that went from 6.8 to 4.9 to 6.4. Looks is somewhere in this range. Okay, 3.8% bulletproof status, let's say. Now, You said, Billy Bob, that is it possible to make more bulletproof if I'm willing to take smaller rewards? Now, you can say this isn't a smaller reward because it has infinite upside. My concern to the customer when he showed me this move that he did is that he's hedged himself out of the position too much, meaning he rolled the put up too far with income method number 4. Now he's sort of hedged out. Now he could go to the islands for a month and not worry about this guaranteed profit. Of course, he'd be upset if while he was gone he saw it go up to 45 and then come back to 30, missed other opportunities, but hey, he's still bulletproof 3.2% to July. Now, how is this lower reward? If the upside is still infinite, you're bulletproof. You can't do anything right now. If I sell a 30 call or try to do any income method with a 30 call, or in this range, 30 or 25 range, what's going to happen? I'm going to create a bearish position that's actually going to lose if the stock moves up. You're bulletproof to the downside with an infinite upside. But if you enter an obligation to do something, you're going to skew it to a bearish trade, and you could lose to the upside. Taking less reward means this position is maybe a little bit too hedged out, even though it's a locked-in profit, because statistically, between now and the next 2 months from now, the stock might move up, but unless it really goes up, he's going to be in this 3-4% range. He's not going to see higher profits above that, unless it starts to really go above 34, 35, 36, and 37. So he's sort of hedged himself out to take lower gains in this range to get the higher guaranteed status if he's wrong and it completely collapses. He actually would have a higher return just leaving it at the 30 or leaving it at the 25 if the stock continued to move up. So, is it possible? Yes. Does it follow the rules in the blueprint? Not exactly. Just like when you open a married put, you only want to be 1 or 2 strikes in. You don't want to go more than 20% in the money. When I look to use income method number 4, I don't want to roll to where I'm now 4 strikes or 5 strikes in the money. I want to keep it in that 1 or 2 strike range. This isn't bad, but I think the 30 was a better choice to maximize upside while still controlling risk and bulletproofing the position, just not as much. Time will tell. This is not an incorrect trade, what he did. Why? Because it matched his goals and it matched his expectations. My tendency would have been to go to the 30, not the 35. Only be bulletproof 0.3, 0.4%, but I could now sell a 30 call without creating a bearish position on a bulletproof status. So to answer your question, Billy Bob, the direct answer is yes, you can. Might not be worth it long term. But you have to have that initial move first to get towards that bulletproof status in that situation. Okay. Sam says, would you bulletproof in stock like Apple or Facebook? I mean, I personally don't. I'm sorry. Everything was out of order, Sam. You bought Apple at 150, FB at 130. Okay, that's where we're going. When we see that Apple's, I'm going to go to another page right now. I'm going to leave that one open. If you have a stock that's up in price, I know many of us don't, but if you have a stock that's up in price, one thing we can quickly do is go into the Married Put tab, go into the tools, and go into the insurance tool. You have Apple at 150. I'm just going to simulate 100 shares to make it easy. And I start off with all expirations. Jeez. Thinking of a different tool there. I'm sorry. So I'm going to put in my stock symbol, Apple. I am going to put in my cost basis, 150, and I'm going to leave it at all expirations. Okay. This is a different view. I always want to make sure everyone sees that. This is a different view. So what this tool quickly did is it shows me opportunities to bulletproof these positions with different expirations. Okay. Now, on the profit and loss chart, we saw a bulletproof status with a negative risk. This is showing locked-in profit. So positive locked-in profit means 3% bulletproof status. You can buy the January 167.50 for $12.58. 21 days out, 3% locked-in profit. then you could trade those as well. Now, I don't see a problem with that, but I usually like to go far term. What I'd normally do is scroll down and see the first month. It's maybe 80, 90 days out. I like this March one at 77 too, to cross me through earnings. So let me pick up March. All right. Now, same situation. Look at the March 180, Sam. 77 days out gives you a 2.5% guaranteed profit. The stock's at 156. This might be too far hedged out. The 160 doesn't bulletproof in March. The 165 does. So here's the decision. Based on your time frame, how long you plan on holding the stock, and how much adjustments do you think you want to put into it, and where you think the stock's going to be. I think 77 days protection at the March 165, based on what you told me you're looking for a rally here on these stocks, having no risk and being able to do adjustments on the inside might be pretty good. It's $14.95. That's true. But again, that's a good, even, no risk doing trades for the next 77 days inside of that no risk Apple construct. Or you could go shorter term, as we saw. We could go to February. You've got anything here with a locked-in profit is bulletproof. The 165 is only at 0.8%. We've got the 165 1st of February at 1.3, 35 days out. And again, the 180, of course, the deeper in the money gives you the best locked-in profit, but you might be too hedged out. Facebook at 130. I'm going to start again with all expirations. Now, this is if you have a stock that's up, or if you have a stock that's you're looking to add insurance on with the married put concept. Plug it into the insurance tool. Stock symbol, cost basis. Here we go. See some locked-in profit for the shorter term, even out to March at 155. Yeah, you've only got 2.5% realized gain, but you've got some low-risk opportunities. You see a negative risk here, negative locked-in profit. That means a risk. So the March 145 put would be a 1.3% risk, still on the position, not bulletproof. If you're expecting a rally, Sam, I hate to say it, but if you're expecting a rally to continue next week and into, wow, next week is already next year, isn't it? Technically, Monday, and then Wednesday, Thursday. Anyway, prattling on here. If you get a little bit more pop, if this goes up to 135, 136, you'll see better opportunities. Naturally, you know that. I know you know that. But it's a good idea. Okay? But that's what the insurance tool shows you. I like the Apple ones better than Facebook just as a look. I'd consider that on the Apple, especially with earnings coming up and talk of, talk of lower stuff as well. Okay? Yeah, BillyBob says, I guess what you're looking for is be able to sleep with no worries. The married put comes close to that, but to bulletproof it, it will require 1 or 2 adjustments depending on the movement of the stock. And yes, after you do that, you will have no worries. Okay? I don't have worries right now at all, even though in some of my positions I still have 5 or 6% risk on the trade. Okay? But 5 to 6% is nothing. Like I showed you in the beginning of the webinar, I don't know if you were here for it, we were talking about the VIX calls. I worry about my bull put spreads and my calendar spreads, which is why I like to have those VIX calls in there in case of the unknown that happened on February 5th to 9th, March 20th to April 5th, a little bit in June, October, November, December. Not unknown at that point. I was more prepared for it, and I stopped trading bull puts in October. But again, that's the trade-off, okay? Scott, you sent me a comment, and I don't know how. I might have missed it while we were talking on something else. Scott, you said, how would this look for rig? I'm not sure what you mean. Do you mean this? Do you mean the insurance tool? And I can't show it unless I have a price, okay? As far as that goes, we're talking about a married put with a riskless spread trade for rig. I don't know what you mean. And if you want to look at the insurance for rig, I'd need to know a cost. Add insurance, rig at 10. Perfect. Thank you, Scott. RIG at $10. All expirations. Okay, so this is down. It's at 701. Here's the problem. This I kind of mentioned that. I mentioned it. It's for a stock that you already have that's, you know, stagnant or just down a little, or stock that's moved up from where you bought it. That's where this insurance tool really benefits. You're down 29%. You could stop the bleeding with deep in the money puts, but then the expectancy of profit, you'd have to be looking far term, okay? Meaning, see how it came up at the top? There's everything is 385 to 749 days out in time. It controls the loss to only maximum of 14.9% now, but in order to get a profit, your break-even's up to $20, $18.08. Do you think rig would go back to $20 even 350 or 400 days out in time? Okay. Let's take a look. Sam wants to know if rig here has still got a good dividend. It used to have one. I haven't checked. RIG's dividend, 15 annual dividends, last ex-dividend, NA. So I think they've maybe stopped dividend, or I'm just, if it's a Canadian company, I forget. We might not have been updating that as well. Scott, what you might want to do, if possible, is take a look at what we talked about earlier, the stock repair tool. Plug in the symbol at the top, go to stock repair. Different tool. This is where I got confused. My cost basis is 10 and I have 100 shares. All right. Shoot. Now there's a debit repair out to January 2009 where you could lower your break even to 873. What is this doing? This is trying to build a ratio spread to help you get back to break even faster. Which in this case I don't see any credit repairs, but there is a debit repair. And in this case, what it looks like you'd be doing is taking your rig position, selling to January 2000, oh, that's 2019. January 2019, 9 calls for 4 cents, buying January 7 calls at 54, with a stock at 701. So you get 8 cents off, but the idea is if the stock starts to move back up, the long call gains, and you've taken in 8 cents to hedge the cost here to only 48 cents. So you've got 1046 in, but your break even's at 873. Why? Because at that price you've made back some of the loss you took on the stock, and your long call would have increased from 54 cents to at least $1.75. Okay, that's the stock repair tool. It gets you back to break even faster, assuming the stock's going to move back up. Although I prefer to do the credit repairs, and none of those appeared. If you average down, and I'm not saying you should, but if you average down, let's say I had 100 shares at 10, I bought another 100 shares at 750. So I've got a total cost basis now of roughly 860 or so. The difference between the two, it's 120, so 870, excuse me. So let's say average down, and I now have 200 shares at 870. I do see a credit repair, but it's out to March. I'd be doing the same thing, essentially. I'd be buying a 7 strike call for March, selling 2 8s for a net credit of 7 cents, which puts my break even at 782. Okay? Okay, so I went to 10. Oh, well, 875, right? If you had a cost basis at 10, oh, no, you're right. Oh, I'm sorry. You had a cost basis at 10. I bought it 7. I thought I was buying at 750. You buy at 7, yeah. Okay, so you'd have 200 shares there. We'd be at 850, right? Yeah. So 10 to 750, that put us at 850, right? Oh, it's 10 to 7. Put us at 850 cost basis. Not 9 shares. There you go. My apologies. Yeah, so you still got the March repair there. Lowers the break even to 772. A May lowers the break even to 759. But that is at expiration. That's not any time between now and expiration. That's at expiration when the time value is gone. And you take a look at that break. Might not be too great. As far as the numbers go, there we go. So this is the new position on rig with the new break even at 772. What do I have to do here? Average down to get a cost basis of 850. Then I see a credit repair with the March 7, March 8. Above $8, you don't get anything more. That's 6.8%. Okay, it's a ratio call spread. Your broker might not see it that way. Just treat it as a covered call with an extra bull call debit spread. That 1 point bull call debit spread plus the small credit you took in lowers that break even down. You get assigned at 8 plus the dollar debit, spread success 9, and then you got some credit too. Okay. Oh, it stopped the dividend in 2015. Okay, yeah, that's why we can't show it. We don't have it anymore. Some of those Canadian companies there weren't doing that. So, Scott, for your case and what we talked about earlier, some of our favorite webinars here, portfolio. Go to the webinars page. Under options strategies, no, options concepts, manage your broken position. Okay, this walks through, and of course, it's powerop.com, webinars.asp. Alternative methods for managing a stock position that's fallen in price, a covered call position that's moved against you, and more. We talk about some of those ideas there for managing the position. That insurance tool I showed you is if you're looking to protect a stock that has a minimal gain, minimal loss, or a big gain, and you want to lock in the profit, that's when you use it. If you have a stock that's down, the insurance tool will help you stop the bleeding, but I think you need to use the stock repair tool instead. Okay, that's the tool that you want to use to see if there's any ratio repairs. Watch that webinar because in it I talk about the pros and cons of averaging down and then finding the repair and even the pros and cons with the repair structure as well. While I am on this topic, and as we are at just about 6:30, I want to say this, okay, real quick. I don't see any other questions coming in. Over the last 12 months, we spent a lot of time on management, talking about managing leverage spreads, managing calendars moving against us, long stock positions. Can I fix a stock that's down 29%? This covered call got away from me. Managing large losses on leverage positions and not. Maybe we should agree to not let the leverage losses hurt our entire portfolio next year and consider picking up the blueprint so that the stocks that you're in are protected at the beginning to a single-digit risk, and then you have the ability to apply the 12 different income methods to lower that risk and bulletproof that BillyBob and I were talking about. And I just want to remind everyone, take advantage right now. If you pick up the blueprint before December 31st, that's when our special end-of-year offer ends for the 7 bonuses, where you can get your first 2 months of Fusion for only $10. We're going to send you one of the Mastery Series videos for free, the Foundations of Radioactive Trading. You'll get a month free of Power Options, full email support, and free shipping, and it comes with a money-back guarantee. Just go to RadioActiveTrading.com, click on the Products tab to pick up your blueprint. So we start off 2019 with protection in place and the ability to control risk with most of our portfolio. And you can still do these other positions, but as I talked in the first hour, position sizing is key for these other structures. Okay? Credit spreads, condors, ratio spreads. You really don't want any position to risk more than 3-4% of your total portfolio because, as we saw, bull puts were successful and popular. All of a sudden, hurt in March, hurt around July, and then October, November, December. And here we are with positions near 90% losses. We want to avoid that going forward as well. So I'll send a link to everyone here. It's radioactivetrading.com/EOY. Consider picking up the blueprint to take advantage of these 3 bonus offers, and we only have about 30 left in stock for the end of the year. So you want to consider picking that up to start off with a proper protection in place in these positions to avoid some of the losses we talked about in the last year and some of the losses that we talked about in today's presentation as well. Scott says, if I have the blueprint, is there anything new that I would need? Remember, you can log on to radioactivetrading.com with the password that was provided for you when you picked up the blueprint and that you were using for Power Options. As a blueprint owner, you have access to any of the updates we've made from your edition of the blueprint to the current one. You may still have the current one, Scott. I don't know. I can't look that up right now while we're on screen. But I want you to consider that. Just go to radioactivetrading.com, log in with your email and your password that you've used in the past for Power Options as well, and take a look there at the blueprint and controlling risk in the next year. While I'm here, I just want to remind everyone again that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks, directions of stocks, bull puts on Apple, bear calls on Apple, so on and so forth, or options discussed today by me should not be taken as trading suggestions. Ideas for management, examples with graphs so we can see how these perform. They're not trading suggestions. Options involve risk, may not be suitable for all investors. The markets are not closed on Monday, February 19th because it'll be a different date in 2019 that's relevant right now. Half day on Monday, I believe, again. Day off on Tuesday for New Year's, so that's what you want to consider. I didn't have a chance to update this. I worked right until 4:29:55 with updating those last slides there regarding Paul's position and Paul's question. Consider picking up the blueprint again. The special bonus offers end December 31st. We only have 30 left in stock right now, so you want to take that. And remember, you can always take a trial of Power Options at any time. Just go to PowerOp.com and put in your name and email address as well. And our subscriptions to Power Options start at $40 per month for end-of-day service, and then only $60 per month for the delayed service with access to all the tools we showed today and the support of the 23 different strategies. I emphasized the webinars page in the first hour of this with links to the other and discussion of where those topics were discussed throughout the year on our Friday discussions. I'm going to post this webinar this weekend, and it's going to be posted in two. Okay, I'm going to put the first 45 minutes up or so of my discussion on my favorite topics, and then we'll just start it new with Paul's question with the debit to credit spread. So there'll actually be two webinars posted at the same time that you can review. Remember, you can also check us out at YouTube as well. All right. All right. Questions. Remember, you can email us at any time, call us during market hours, or schedule a coaching session as well. Okay. Sam says, thank you so much. Very kind to teach us. Sam, thank you. You've taught me a lot over this year, as has Rajiv and Paul even. Of course, I should say not even, but Paul, Mark, all those others that we had, JD, Victoria, Fernando, who we haven't seen in a while. Of course, he's out in Italy, so he doesn't always have the time, but it's great to see from all of you. Sam also says, have a nice week and enjoy to all the traders in the room. So everyone have a good week next week from Sam. BillyBob, I need you to send me an email. Doesn't matter to which one. Support at PowerOp.com, support at RadioActiveTrading.com. Doesn't matter which one after the webinar. I sent you an email to the email address you registered for on the webinar yesterday about your blueprint. I also included it with an email, I think, that is also you, that's from an older account in 2012 in our database. I didn't hear back from you, so you might have missed that. I think it would have come from Mike at RadioActiveTrading.com or Mike C at PowerOp.com. I did not get your reply regarding that as well. Okay, regarding what we talked about before about updating your addition to the blueprint. I need a little bit more information for you and to check something out there. So send me an email or check your email for my email and reply back to me. I sent you that the other afternoon. So just send me an email so I can reply directly to you. I'm not sure if the email didn't go right or not, but that's what we're missing. All right, whoop, black screen, didn't want to do that. Thank you very much, ladies and gentlemen, for a spirited and educational and enlightening discussion over the past year on our Friday sessions. I greatly appreciate it. I greatly appreciate you spending time with me. I greatly appreciate your questions, and I learned from you a lot, as hopefully you've learned from me. I look forward to seeing what we have coming out in 2019 with the questions ahead, and I'll get these posted soon for you this weekend, as well as other information as well. So take care, everyone, and if I don't see or hear from any of you on Monday, everybody have a happy New Year's, and those of you who are watching the recording, you have a happy New Year's as well and a profitable 2019, but we'll still be around to take your questions throughout 2019 as well. Good night, everybody. See you soon.